The grand ballroom of the Federal Reserve building hummed with nervous energy on that September evening in 2008, as the titans of Wall Street gathered for what would become known as the most consequential weekend in modern financial history. As the CEO of Lehman Brothers sat across from his competitors, who would soon divide his empire among themselves, a familiar pattern was unfolding, one that has repeated itself with clockwork precision throughout the centuries. The collapse of financial markets isn't just an unfortunate accident of capitalism. It's a feature, not a bug, and those who understand this dance between boom and bust have learned to profit handsomely from the misfortune of millions. Picture a medieval marketplace in Venice during the 1340, where the great banking houses of Bardi and Peruzzi extended vast loans to Edward III of England for his wars against France. When the English king defaulted, sending shockwaves through the Italian peninsula, the wealthy merchant families who had kept reserves and maintained relationships with other powerful entities swept in to acquire the assets of their fallen competitors for pennies on the dollar. Fast forward nearly 7 centuries, and you'll find Jamie Dimon of JPMorgan Chase executing precisely the same maneuver when acquiring Bear Stearns and Washington Mutual during the 2008 crisis. The names change, the technology evolves, but the fundamental mechanics remain eerily consistent. The story begins with human psychology, that unchanging constant that makes us simultaneously brilliant and foolish. During periods of prosperity, memory fades like morning mist. The banker who lived through the last crash retires, replaced by eager young traders who've known only rising markets. The grandmother who remembered breadlines and bank runs passes away, leaving grandchildren who can't imagine a world where their investments might evaporate overnight. This generational amnesia isn't accidental. It's the fertile soil in which financial crises grow. The large institutions understand this cycle intimately. They've studied it, modelled it, and most importantly, they've positioned themselves to benefit from it. Consider how the pattern unfolds with almost musical predictability. First comes innovation, often technological or financial, that promises to change everything. In the 1920s, it was the democratization of stock ownership and buying on margin. In the 1990s, the internet would revolutionize commerce forever. In the mid-2000s, financial engineering had supposedly eliminated risk through securitization. Each time, the promise seems genuinely different, genuinely revolutionary. The large financial institutions, with their armies of analysts and historians, recognize the pattern but play along, knowing that the real money isn't made by avoiding the bubble but by controlling its inflation and managing its deflation. During the boom phase, these major players engage in what appears to be reckless behavior but is actually calculated risk-taking. They know the music will stop, but they also know that when it does, they'll be the ones choosing who gets a chair. Goldman Sachs didn't survive and thrive through multiple crises by accident. They did it by maintaining liquidity when others leveraged everything, by building political relationships that ensure they're at the table when bailouts are discussed, and by structuring their risks so that they're too interconnected to fail without bringing down the entire system. The build-up to every crash follows a remarkably similar trajectory. Credit becomes increasingly available as competition among lenders intensifies. Standards drop imperceptibly at first, then dramatically. The subprime mortgage crisis didn't begin with ninja loans. No income, no job, no assets. It began with slightly loosened standards that seemed reasonable at the time. A credit score requirement dropped from 700 to 680, then to 650, then to 600. Down payment requirements shrunk from 20% to 10, then 5, then 0. Each step seemed logical in isolation, especially when competitors were taking the same steps and capturing market share. Meanwhile, the financial press, dependent on advertising from these very institutions, amplifies the euphoria. This time is different, they proclaim. The old rules no longer apply. We've entered a new paradigm. The Federal Reserve, staffed by alumni of these same financial institutions, maintains policies that keep the party going. Interest rates stay low, liquidity remains abundant, and anyone suggesting caution is dismissed as failing to understand the new economy. The large institutions don't believe the hype, but they benefit from everyone else believing it. As the bubble reaches its maximum inflation, the smart money begins its retreat, but quietly, carefully, so as not to trigger panic. Warren Buffett's famous line about being greedy when others are fearful, and fearful when others are greedy, isn't just folksy wisdom. It's a precise description of how wealth transfers from the many to the few during these cycles. The major institutions begin reducing their exposures, hedging their bets, and most crucially, ensuring they have enough liquid capital to survive the coming storm and feast on the wreckage. The trigger for collapse can be almost anything, and that's part of what makes the timing so difficult to predict. It might be a major bank failure, a sovereign default, a pandemic, or simply a collective realization that prices have lost touch with reality. But once the selling begins, it becomes self-reinforcing. Margin calls force more selling, which triggers more margin calls. Credit evaporates as lenders suddenly remember risk exists. The very innovations that seemed so brilliant during the boom become accelerants for the bust. This is where the true advantage of the large institutions becomes apparent. While smaller, players are forced to sell assets at any price to meet obligations. The major banks and investment firms, often freshly supplied with government capital, can go shopping. During the 2008 crisis, JPMorgan Chase acquired Bear Stearns for $2 per share, later revised to $10, for a company that had traded at $172 just a year earlier. Bank of America bought Merrill Lynch. Wells Fargo absorbed Wachovia. The concentration of financial power that resulted from the crisis exceeded anything seen since the age of JPMorgan himself. But the advantages extend far beyond simply buying distressed assets cheaply. During crises, governments invariably intervene, and when they do, they turn to the large institutions as partners. Who helped structure the Troubled Asset Relief Program? Who advised the Treasury on which institutions should be saved and which should be allowed to fail? Who provided the expertise to manage the complex unwinding of derivatives positions? The very institutions that had created the crisis became indispensable to resolving it, and they were compensated accordingly. The relationship between large financial institutions and government power creates a feedback loop that virtually ensures the cycle will continue. Former executives of major banks rotate into regulatory positions, then back to the private sector, creating what critics call a revolving door, but what participants see as necessary expertise. When Robert Rubin moved from Goldman Sachs to Treasury Secretary and championed the repeal of Glass-Steagall, which had separated commercial and investment banking, he wasn't engaging in some conspiracy. He genuinely believed, based on his experience, that large, diversified financial institutions were more stable. That they also happened to be more profitable for those who run them was, from his perspective, merely alignment of interests. This symbiosis extends to monetary policy as well. Central banks, tasked with maintaining financial stability, have increasingly interpreted this mandate as preventing any significant market decline. The Federal Reserve's response to every crisis since the 1980s has been to lower interest rates and increase liquidity, essentially validating the risk-taking that led to the crisis while punishing savers and conservative investors. This creates what economists call moral hazard, where the profits from risky behaviour are privatised while the losses are socialised. The European debt crisis of the early 2010 provided another textbook example. As Greece, Ireland, Portugal, Spain, and Italy teetered on the edge of default, the European Central Bank and International Monetary Fund intervened not primarily to help these countries' citizens, but to ensure that German and French banks, which held much of the debt, wouldn't face catastrophic losses. The austerity measures imposed on the debtor nations created widespread suffering, but the financial system was preserved, and the large banks emerged largely intact. Each crisis also provides cover for regulatory changes that further entrench the advantages of large institutions. After 2008, the Dodd-Frank Act in the United States and similar regulations worldwide increased compliance costs dramatically. While intended to make the system safer, these regulations created barriers to entry that smaller competitors couldn't surmount. The cost of compliance became a fixed cost that only institutions with massive scale could absorb efficiently. Community banks, which had nothing to do with creating the crisis, found themselves crushed by regulations designed to constrain too big to fail banks, which only became bigger and more essential. The technology sector has now joined this dance, with firms like BlackRock using their Aladdin risk management system to become so integral to the global financial system that they're arguably more important than any traditional bank. When markets stumble, everyone from central banks to sovereign wealth funds relies on BlackRock's analysis and execution capabilities. The company manages over $10 trillion, more than the GDP of every country except the United States and China. Their influence on markets isn't just about the money they manage directly, but about the information advantage their system provides. Cryptocurrency was supposed to disrupt this pattern, offering a decentralized alternative to the traditional financial system. Yet watch what happened as crypto matured. The same large institutions that initially dismissed Bitcoin as a bubble or fraud gradually built positions, created trading desks, and developed custody solutions. When crypto markets crashed in 2022, who had the resources to acquire distressed crypto assets and companies? The traditional financial giants, of course. FTX's bankruptcy saw its assets picked over by established players who understood that every revolution eventually becomes the establishment. The pandemic provided perhaps the clearest modern illustration of how crises benefit large institutions. As small businesses shuttered and millions lost jobs, the Federal Reserve embarked on the most aggressive monetary expansion in history. Asset prices soared even as the real economy struggled. Large corporations borrowed at near-zero rates to buy back their own stock, enriching executives and shareholders. Private equity firms raised record amounts to purchase distressed assets. The wealth gap, already wide, became a chasm. The stock market reached record highs while food bank lines stretched for miles. But here's what makes this system so resilient, and why it continues despite widespread recognition of its inequities. It works, at least for those with the power to change it. The financial system, for all its flaws and periodic crises, has generated unprecedented wealth and innovation. The same mechanisms that create instability also fund technological advancement, entrepreneurship, and economic growth. The large institutions argue, not entirely without merit, that their size and sophistication allow them to intermediate capital more efficiently than a fragmented system of smaller players could. Moreover, the interconnectedness that makes these institutions too big to fail also makes them genuinely essential to the functioning of modern economies. When Lehman Brothers was allowed to fail, the cascading consequences nearly brought down the entire global financial system. The money market funds that seemed safe, the commercial paper market that funded corporate operations, the letters of credit that enabled international trade, all froze simultaneously. The lesson policymakers took wasn't that the system needed fundamental reform, but that no major institution could be allowed to fail again. This creates a paradox that benefits large institutions enormously. They can take risks knowing that if those risks pay off, they keep the profits, but if they fail catastrophically, governments will have no choice but to rescue them. This isn't capitalism in any classical sense. It's a hybrid system where profits are private, but losses are public. The executives who make these decisions rarely face personal consequences. Dick Fuld of Lehman Brothers may have lost his job, but he walked away with hundreds of millions in compensation from his years running the company into the ground. Angelo Mozilo of Countrywide, which pioneered many of the worst subprime mortgage practices, paid a fine that was a fraction of his personal wealth and avoided criminal prosecution. The regulatory capture extends beyond just the revolving door between government and finance. Academic economics, which provides the intellectual framework for policy decisions, depends heavily on funding from financial institutions. Research that might fundamentally challenge the system struggles to find support, while work that suggests minor technical adjustments receives generous grants. The brightest economics students are recruited to Wall Street with salaries their professors could never match, creating brain drain from public service and academic research into private profit maximization. Central banks, supposedly independent guardians of monetary stability, have become increasingly responsive to market sentiment. The Federal Reserve's pivot in 2019, when it reversed course on interest rate increases due to market pressure, demonstrated that the tail now wags the dog. Markets don't respond to central bank policy so much as central banks respond to market demands. This dynamic ensures that asset bubbles receive official support until they become too large to manage, at which point the inevitable crash triggers demands for more support. The international nature of modern finance makes reform even more challenging. Any country that imposes strict regulations risks seeing financial activity migrate to more accommodating jurisdictions. London's light touch regulation helped it compete with New York. Singapore and Hong Kong attracted business from both. Dubai and Shanghai are building financial centres explicitly designed to capture market share from Western capitals. This regulatory arbitrage ensures that the race often goes not to the safest or most stable system, but to the most permissive. Even the language we use to discuss these issues has been shaped by large institutions. A market decline is a correction, implying that previous prices were somehow wrong. Government support for failing banks is a rescue or stabilisation, not a subsidy. Executive compensation is aligned with shareholder interests, not extraction of value. The complexity of financial instruments is portrayed as sophisticated innovation rather than intentional obfuscation. This semantic manipulation makes it harder to even articulate critiques of the system without sounding naive or uninformed. The rise of index funds and passive investing, while beneficial for individual investors in many ways, has created new dynamics that favour large institutions. As more money flows into index funds, the largest companies automatically receive the most investment regardless of their fundamental value. This self-reinforcing mechanism makes the big bigger without regard to merit. The major financial institutions, being among the largest components of most indices, benefit directly from this dynamic while also managing many of the index funds themselves, earning fees on assets that require minimal management. High-frequency trading, algorithmic execution, and artificial intelligence have created new advantages for institutions with the resources to invest in technology and data. The millisecond advantages that come from having servers physically closer to exchanges, the ability to process vast amounts of information instantly, and the capacity to execute complex strategies across multiple markets simultaneously are available only to the largest players. The individual investor, even a sophisticated one, operates in a market increasingly dominated by machines programmed by and for major institutions. Environmental, social, and governance investing, or ESG, has become another tool for large institutions to maintain their advantages while appearing progressive. By defining the metrics that matter and controlling the ratings agencies that evaluate them, major financial firms can direct capital flows while claiming moral authority. An oil company with good governance scores can receive more investment than a renewable energy startup with poor documentation. The complexity and subjectivity of ESG metrics create opportunities for gaming the system that favour large, sophisticated players over smaller, potentially more genuinely sustainable competitors. Looking ahead, the pattern seems set to continue and potentially accelerate. Climate change will create enormous economic disruptions that will trigger financial crises. The transition to renewable energy will strand trillions in fossil fuel assets. Rising sea levels will destroy coastal real estate values. Extreme weather events will bankrupt insurers. Each crisis will create opportunities for those with capital to deploy when others are desperate. The large institutions are already positioning themselves, creating climate risk models, developing green bonds, and establishing relationships with governments, planning massive infrastructure investments. The digitalization of money through central bank digital currencies will give governments and financial institutions unprecedented control over economic activity. Every transaction could be tracked, taxed, or blocked. Negative interest rates could be imposed directly on digital wallets, forcing spending. The large institutions are partnering with governments to develop these systems, ensuring they'll be intermediaries in the new monetary regime just as they were in the old. Artificial intelligence and quantum computing promise to make financial markets even more complex and fast-moving, further disadvantaging human traders and smaller institutions. The firms that can afford the best technology and brightest minds will have advantages that compound over time. The possibility of artificial general intelligence achieving superhuman trading capability raises questions about whether markets will have any human participation at all, beyond providing capital for machines to manage. Yet, for all the seeming inevitability of this system, history also teaches us that no arrangement lasts forever. The Italian banking houses that seemed invincible in the Renaissance gave way to Dutch finance, which yielded to British dominance, which was superseded by American power. The dollar's role as reserve currency, which underpins much of the current system, faces challenges from digital currencies and alternative payment systems. The political consensus that supports bailouts and monetary expansion shows signs of fraying as populist movements on both right and left question why bankers receive socialism while everyone else gets capitalism. The genius of the current system, from the perspective of large institutions, is that it has evolved mechanisms for self-preservation that previous systems lacked. By making themselves essential rather than merely powerful, by capturing regulatory and political processes rather than opposing them, by creating complexity that makes reform seem impossible rather than merely difficult, they've built a fortress that seems impregnable. But every fortress, no matter how strong, has weaknesses. The question isn't whether the cycle of boom and bust will continue, it will, but whether the benefits will continue to flow predominantly to the same players. The story of financial crises isn't ultimately about money or markets, but about power and human nature. As long as humans are greedy during booms and fearful during busts, as long as memory fades and hope springs eternal, as long as complexity can obscure simple truths and political influence can shape economic outcomes, the cycle will continue. The large institutions don't create these human failings, but they've become masterful at exploiting them. They've turned the recurring catastrophe of financial crisis into a reliable business model, transforming collective misfortune into concentrated advantage with such skill that we've come to see it as natural, even inevitable. The perpetual recurrence of financial crises isn't a bug in the system that needs fixing. For those who profit from them, it's the system working exactly as designed. Each crisis presents itself as unique, unprecedented, requiring emergency measures that invariably preserve and strengthen existing power structures. The players may change, the instruments may evolve, but the fundamental dynamic remains. During booms, risks are socialized through the financial system. During busts, losses are socialized through government intervention, while a select few emerge stronger from each cycle. This isn't conspiracy but convergent evolution, where institutions that survive multiple crises naturally develop strategies to profit from them. Until we recognise that the problem isn't preventing the next crisis but changing who benefits from it, we're doomed to repeat this cycle, each time expressing surprise at its familiar contours, while those who've studied the pattern carefully position themselves to profit once again from our collective amnesia.